Recording in progress.
Hey guys, give me a second here. Happy Thursday. What a day it was. Make sure I can, yep, get a thumbs up if you guys can hear me okay. Anybody? There we go. Okay, sounds good. All right, we're right into Apple's earnings, and let's see if we're getting anything yet. Reaction, yes, to the upside so far. Not bad. Hit 263, but yeah, good reaction to Apple's earnings. That's a good thing. So that should help the market tomorrow if it holds up. So especially after a day like today where we basically were down, we're up 100 points from the lows on the S&P futures, guys. I mean, this is just wild. And the NASDAQ futures are up 400 points almost, no, almost 500 points from the intraday lows. So we hit those lows and we just kept rallying. And the S&Ps took back the 10 EMA. So it is really wild. And so unbelievable what we're seeing in this market. So yeah, S&P futures back up to 7,000 and the SPX is within 31 points. So I hadn't planned on coming on camera today. I haven't shaved, but you know, I won't stay on here for very long. So it's been that kind of day, guys. So it started 5 o'clock Eastern time and it's been going nonstop. So let's take a look at things and try not to drag this out too long so everybody can get back to their lives and dinner and what have you. So I'm glad you could join me. It's Thursday, January 29th, 2026. We are down to one trading day left in the month. So that's tomorrow. And we shall see what that brings if we close here. I think we're still positive on the month. Let's bring up that chart and I'll come back to that. So what do we have? Michael didn't shave either. All right. This is not the time for confessions here, Michael. The window, yes, that is a fall window or what have you, a fake background, if you will. So I wish that was my view, but it is not. So at this point, I am going to get off camera and you guys don't have to stare at my unshaven mug. And that way we have the screen to what's important here. And so let's take a look at what today looked like. And Apple's holding some gains here. I think that's going to determine direction tomorrow, albeit tomorrow is the last day of the month. So there's shenanigans that in there. And so you can see here, right down the middle here where I'm highlighting, that's the change in each of these industries for the day. And cannabis is the worst of them. Actually, software was. And, you know, I'll confess, I have some positions, longer term positions that I started in Adobe and CRM software, Salesforce, and they are taking a beating. And I mean, the fundamentals in those are excellent, but software companies are just taking a beating. So it's they're very small positions, but you know, I'm getting tired of getting thrashed around with those two names, and probably should have dumped them a long time ago. These are June and September options. And so you can see in this column here, this is how these particular industries fared since the open. And so I guess the best one that fared from the open It was IYT, the transports, but for the rest, um, although the indices lifted off the bottom, there wasn't a lot of participation. In fact, Microsoft until the last half hour had really little lift in it. I mean, maybe we went up what $6 or $7 in the end, but that was a terrible report. And for those of you who like to quote play earnings, I don't play earnings anymore. I used to, and once I studied my trades, it was over because it was no better than a coin toss in terms of my wins. And even trying to grab premium from an earnings event and take advantage of the volatility collapse, that was also a crapshoot because for every time that I made it out unscathed with the premium, I've encountered a 2 or 3 standard deviation move in a stock, and my short iron condors or my short calls and short puts just got hit. So I just say, no, don't do earnings. But what I want to get expressed to you guys is I don't play earnings, and I didn't play earnings, but I do have long-term positions in Facebook or Meta, Microsoft, IBM, and what's the fourth one that reported today? Tesla. Okay, so I have long-term positions in all of those, and not only I do, but my clients do too. And so um, it was like playing earnings only with long-term positions. So what do we have? 2 of them up, 2 of them down. And so on earnings, I broke even on the day. So I got hit bad on Microsoft and not so bad on Tesla. And I made money on IBM and I made money on Meta. So just goes to show you what I'm saying is that it is a coin toss, just even on my long-term positions to see how you fare through earnings. So take that for what it's worth. But you can see here, I mean, it looked really bad this morning. And in the end, I don't know why the SPY isn't populating, but the SPY was down less than 1/4% as far as I can tell on the day. But, ARKK faring the worst, and small cap growth is also down 0.5%. But the DIA, the Dow Jones Industrials, eked out a gain on today. Wild, wild day, guys. So let's take a look and see what we have here. So what I can do to clear this up in a second is eliminate these drawings. But here's what we have is the daily, weekly, and the monthly chart. And we'll start with the daily. And here you can see today's candle. It's almost like a bottoming tail hammer, but I don't think you can have a hammer when you're in an uptrend, but whatever. You can see the MACD is trying to flip positive, and until today it was looking good, but this was a definite test of support here. And you can see that I have a new line here. Remember last week I said 69.27 was the line, the bull bear line, and we closed above that not yesterday, I think even the day before, and I put something in the forum about that. And so once that happened, so I remeasured and said, okay, now this 69.27 should be support, but I'm going to give it to about 69.15, and this is my new bull bear line. At least in the short term, 69.15, and that is the January 21st close. It's where we have this little doji here, and yeah, we went all the way down there. We almost hit my 68.40 support, but we got as low as 68.70, and we definitely bounced there. And maybe tomorrow we'll see new all-time highs again. This is what a crazy market it is. And so we are right in between. The options implied expected move was down here. We never threatened it at all down here today at the 67.97. And we are actually closer to the upper edge of the options implied expected move for this week, and we'll take a look at what is remaining in the SPX um, for the week. Looking at the weekly, and I think if I let me do something here. Where are my? That's the studies. Where's my little thing for? Okay. Uh, that makes it a little easier to see, no? All right. So here's our weekly chart, and we're holding above the 8 EMA on the weekly chart. Last week we had a little dipsy doodle to the downside. We are on a MACD sell signal, and we're not only not no longer going sideways, it's kind of slanted down a little bit. So we need to get some more a little bit of flip up on the weekly for this to negate the sell signals. Now the sell signals over the past year on the weekly have a mixed record in terms of what happened after we had the sell signal. And here you could see we've been in a sell signal since November, and we're still making new all-time highs. We got into a sell signal last year in February, March, and that one actually worked because we went down into April. So MACD is negative, but above the zero line, and our RSI is at the 64, not quite overbought, not quite neutral level. So let's take a look here on the monthly chart. And which one do I want? No, I don't want the studies. Where? Okay, there's take that. Okay. So here we go on the monthly. Nothing wrong with this particular chart. We are one-time framing to the upside on the monthly. MACD certainly positive, and we have an RSI that's definitely overbought and staying that way, and that's what you need. Bullish chandelier and PSAR on the monthly, same with the weekly and the daily. So the worst you can say here is the daily chart is full of noise and choppiness, and the weekly and monthly basically trump both, trump the daily chart. So advantage here is still to the bulls, and today's strength is a testament to how much the bulls have things on their side. And if you're a bear today, you are crying in your soup if you didn't cover early this after we bottomed out at 68.98. So if you are one, sorry about that. I had some puts and some inverse funds. I covered those, not enough, but in days like today, when it's so bad, you expect some follow through, but not in this market to the downside. We're not seeing it. So, all right. So as of this moment, looks like Apple popped and now giving a lot of that back. And so you can see in the after hours futures that we have topping tails on the 15-minute charts, which here is the daily chart, long tail here. We're closer to the top of the options implied expected move than the lower end of the options implied expected move. And look at that tail. I mean, that's nasty if you're trading this. And MACD is solidly positive. So the one thing about this week, which started actually on Friday of last week, is the baton has been passed to technology. So that's been doing its thing. And I'm sure that Dan and why can't I think of his name? Scott are doing their thing, talking that up as well. So we've got the RSI at the middling level. On the weekly chart, MACD is still solidly negative, but above the zero line, and MACD is at the 61 level, just above the neutral level. So looking really good on the weekly chart. and holding above the 8 EMA, and nothing wrong with this, and right in the middle of the options implied expected move. Again, we did not even come close to touching, as you can see from this long tail, not even coming to the lower edge of the expected move. And then here we are with the monthly chart looking fantastic. And so far we have a doji on January, but let's see, the close in December, December 25,249. And I think we're comfortably above it. So this will, we're at 25,885. We're going to close positive on the month unless something really bad happens tomorrow. But we need 26,182. That's what? 236, 226 points to get there. Yeah, 226 points to get, if I'm doing my math right, 182 and 116, 200, call it 300 points. So doing the math in my head here. MACD's is totally positive, and we are overbought on the RSI. So definite advantage to the bulls here on all time frames, and what a recovery it was today. So hopefully Apple holds up and keeps the NASDAQ rolling tomorrow. And boy, wouldn't it be great if we got a 300-point move tomorrow and made an all-time high before the end of the month? That would be good for the bulls. And I was thinking about putting out a QQQ trade today. And I looked and I said, I can't find anything that's really, other than putting out a lot of premium, that I wanted to do. So maybe tomorrow. RUT, if you're in a rut, these are the small caps. And while the technology took over the baton for leadership, the Russell 2000 small caps just basically didn't even give up a fight. I mean, we have what, 4 out of the last 5 days were negative in the Russell after this topping tail there a week ago today. So 2735, and we quickly are at 2654. In fact, we were all the way down, call it 120 points at the lows today. MACD has flipped negative here, and RSI, the relative strength index, is kind of neutral. Looking at the and you also have the bullish chandelier and bearish PSAR, so kind of mixed bag. We'll see if the small caps can get back in gear. So they too did not touch the lower edge or the upper edge of the options implied expected move. Nice little wick down there. On the weekly, we have right now 3 sideways candles. So this was a nice candle, topping tail there, and so far we're forming a doji on this weekly candle. MACD solidly positive. It's good, way above the 0 line, and we're pulling back from the overbought level on the RSI. So this could be just weekly consolidation. So even though the daily doesn't look great, this looks okay. And then going to the monthly, solid MACD. Still haven't gotten overbought on a monthly basis. I mean, we have to go back to 2021 for the last time where we had any persistence on the monthly chart being overbought on the RSI. And that's the thing. When you have a bull market, you have a trend, you have momentum, you get an overbought RSI, and it stays that way for months and months, as we've seen on the SPX. But definitely a bullish chart here. This is still bullish. Daily, not so much, but we'll give the benefit of the doubt to the bears. The bulls, I'm sorry. VIX here. Take a sip here. So Apple is holding at 260, and as you can imagine, I have a position, and most of my clients also have a position. If they don't have a position directly in Apple And any of you have a 401k, I'm sure you know that you have a ownership in Apple. So obviously a very important big stock for all of portfolios. VIX, look at that. We ended up 3.25% after basically threatening 20. We didn't even hit 20. So that was a little bit of a clue for me this morning that damage isn't going to get so bad. But we were up at one point 16, 17, 18% on the VIX. And once again, knocked down, topping tail on there. MACD looking to flip negative on the daily. Don't much care for these, but let's take a look at the VVIX. What did it do? Well, we ended at 101, so it has our attention, and it got as high as 111.92, not even 112. And if we look back at this one, the one on the 21st, when we had that little dipsy doodle in the market, we hit 112.7, we hit 113 and a half. So we didn't even get up there today. So I'm not sure what we had going on, but there were some geopolitical news, nothing severe in the morning, something about China repositioning and a couple other things going on, something with oil and yeah, so that could have been just a temporary scare or some portfolio managers really dumping stuff ahead of the end of the month. We may never know. We don't care. We just play the action. So let's take a look at what's happening. And I'll come to your questions in a minute. Let's see what's happening with the VIX options. Now, when I looked this morning, VIX options calls were pricing a lot more expensively than call puts. So we're at 1688. So let's call it 17, a close at 17. And if we take a look at $1 out of the money, 18 calls are about $1 and call it 94 cents. Go $1 out of the money to the 16, so they're priced at 18 cents. So the advantage here goes to the bears. So we're looking $1 out of the money on the puts, and you would be buying these if you were bearish on the market. And if you were bullish on the market, you'd be buying the puts, saying you expect VIX to go down. And so these would actually cost 16 cents versus $2. So the advantage is definitely with the bears on the VIX call, so that we are pricing VIX calls higher. So there might be something there. Let's take a look at the structure of the VIX futures, and we can see that it is in its normal contango configuration, which means the farther out the expiration, Feb, March, April, May, and June, the higher the VIX, which is what you would expect in terms of higher volatility for higher uncertainty as you go out in time all the way out to 139 days. So at no point today did I see the spot VIX exceed these VIX futures. Obviously, they've all come down from their highs today, but definitely the spot VIX, when it takes over and leads all the futures, VIX futures, then they call that backwardation, and that's where the risk is here and now. So looking good there. One last thing we'll want to do is take a look at the options implied expected move. We were expecting 118 points for this week. With an FOMC meeting, a lot of meaningful earnings and other economic reports. And so what's remaining for tomorrow, the last day of the month? We've got 46 out of the 118 points remaining for tomorrow. So not quite half. So 118, 59 would be half. So, but relatively speaking, a disproportionate amount of the 118 points left for the last day of the trading week and the trading month. So we're not out of the woods yet, but we are only at what, a 17 VIX, and if Apple is going to provide any ballast for the market, it better do it first thing in the morning. But there's also some month-end window dressing shenanigans going out. So Jay says, I know you're going to discuss Palantir seeing it close below the stop price. What is it? Is the plan still to close at opening? Would I still recommend the hood trade? Thanks for all the great trades. You're welcome, Jay, and thanks for being here. So what I was looking to do today, and we'll look at Palantir just since you brought it up, and I am going to discuss it. And when it was down at 149, I was going to put a note in the forum. And as you guys know, I'm a registered investment advisor. I got to be very careful about putting investment recommendations. So I was adding to client portfolios today down, even though it's below the 200. I don't care that it's below the 200. And so I am probably very much going to move the stop, if not move our put spread. They have earnings next week. I understand you might be nervous about this, and if it's getting too big or too big of a loss for you, I understand you may have to close it. But I am not going to close this put spread. I'll either move it or we'll give it a chance to recover. This stock is something that I'm going to own, and my clients are going to own for months. And you don't have to have my conviction. You don't have to have my belief. But I can tell you that I would be adding or initiating a position in the common hero stocks or a leap or something. I think this is an opportunity. And I think the earnings, one of the reasons that I really didn't put things out is because of earnings next week. And so you may want to wait until after earnings to make a decision to do this. And if this stock gaps down 20, 30 points, then I have egg in my face and you guys are going to hate me and you're going to cancel your memberships and what have you. But we're all adults here. And so you have to make your decision for yourself. But if you're skeptical, buy a share or two, tuck it away forever. But I still think that this stock long-term is heading for $400 or $500. The fundamentals are fantastic, and I would say this stock is probably in the second or third inning of its run. So take it for what it's worth. That's my personal opinion, and my standard disclaimer is I'm not your investment advisor. So don't take any of this as an investment advice. Make your own decision on what you want to do. But as far as our put spread, we'll look at the trades in a minute. We'll probably end up rolling it, not closing it. But I think this fell victim also to a lot of the tech selling that happened, although it was kind of disappointed that it didn't recover more from the bottom. It got as low as 147. So let's say it recovered about $5, but I still love the stock and I'm not worried about it one bit. But I do understand, and I'm not tone deaf to a lot of you who see these $400 or $500, 400 or 500% losses, and it concerns you. And we've already rolled it once. I recognize that. So let me see if I have any more questions. Okay. Would I still recommend the hood trade? Yeah. This was a long-term play. Maybe you want to wait until the earnings next week before you initiate, or initiate a third or half before earnings and do the rest after. But make no mistake, this is a long-term play. This is a stock that's in the downtrend. But if there was ever a time to initiate a position, this would be it. And this is not MSTR where you're basically live or die by the price of Bitcoin. This is a solid stock. I love what they're doing. And in fact, this is on my list to initiate positions in client portfolios. I haven't done that yet. So there are certain things I have to do before I put a stock in clients' portfolios, and I haven't put my package together, so to speak, to kind of justify it, or not justify it, but to explain my decision, so that it goes in the files. And if I'm ever confronted with a regulator, why did you buy Hood for your clients? And I have the research to back it up, and I like Hood. So good. Curious to know why M200 MAPLTR is not your line in the sand. Michael, very good question. And it's not my line in the sand on Hood. When I'm making a long-term investment that is basically down 33% from its high, could this go lower? Sure. But I was buying Target way below the 200 day line when it was like 50, $60, and we wrote it up. When you're a portfolio manager, and again, you have to have a long-term perspective on whatever stock that you're buying. And I've been doing this for 35 years in terms of professional money management. And 200-day is there. It's great for trading positions, but I'm talking about long-term positions. And in my mind, even on these bull put spreads, if I have conviction in the stock, then I'm going to roll them out and give ourselves more time and room to be right. And it's one of the things we're going to cover in our lesson today about selling premium. And we touched on it last week, but we are going to harvest our winners, and we're going to manage the losers. And I know that goes against totally everything you learn about trading, is that you cut the losers, and you let the winners run. Well, when you're selling premium, then and especially since we are still in a bull market, then I can still be very liberal and generous and accepting of more drawdowns. And so we definitely have a loss in Palantir on our bull put spread. And like I said, we rolled it once, but if I thought the stock was done for and it was heading for $100, then we wouldn't do this. And if I thought the market was not supportive, then I wouldn't do this. So the 200-day moving average is definitely something on my trader radar, but it's not something, when I'm looking at something long term and I have conviction in it, that I care about. And yeah, they say nothing good happens on the 200-day line. Yeah, but let me show you where we bought Target. And when the value gets too compelling, you got to buy. And it was no, it was even less than that. I think we were somewhere about, yeah, 60, $70. So we bought it somewhere around here, $83. And this stock went all the way up to $268. And we were harvesting profits all the way. And this is why we have Hormel. I'm looking at hopefully another target, at least for a double or a triple for us. Obviously, these are monthly charts, and we're just getting started. And it took months for this thing to get going. But, and if your rules say you have to be out at the 200-day, then, you get out at the 200-day. My conviction doesn't have to be your conviction. And so this is your money, your livelihood, your risk. You have to determine it. But if you accept what I'm saying and you believe in my conviction and my research, then you decide how much you're willing to risk. And if it's too much for you, then you have to get out. And to me, the 200-day is just another arbitrary line that everybody sees and will trade against. But eventually, when fundamentals matter, and portfolio managers don't care about these lines. They'll buy when the value is compelling and they see the fundamentals supporting a future run. And it is the institutions, after all, who are buying, who push it back up over the 200-day. So, and if, just to be clear, if we weren't in a bull market, and I just showed you all the charts, and the advantage is to the bull side still. So I can be a little bit more liberal with my stuff. Hopefully that helps you. And if you have a counter argument or counter point to me, Michael, I welcome that. You can type it in and we can discuss it. So um, yeah. And I couldn't think of Scott's name. Thanks for that. So if you have any more questions, let's put them in and let's take a look at our trades. And let's see if I can do this right this time. Make this, maximize it. Apple seems to be holding up. It's not, so it closed at 258 and it's at 260. So it's up a couple of bucks. So it's not exactly tanking, but obviously anything can happen once the conference call gets underway. Apple is another one that I have conviction in, and you can listen to all these people talking about Apple is done and there has been, and they're way behind on this and that, but you know everything I read, everything I research says that every time this happens, uh, somehow or another, Apple tends to um, end up coming out looking like a rose. And I don't think this is going to be any different when they start integrating AI into things and they're getting a lot into healthcare. And just imagine what happens when Apple is finally able to convince what is it, the Department of Health that the iPhone is a medical device. Then if it's certified as a medical device, the monitoring, all of that, then now you have Medicare or Medicaid or insurance plans that will start paying people for their iPhones. Can you imagine how much demand that would be? Now, maybe that's pie in the sky stuff and it'll never happen, but that's just one thing. And I don't like the fact that Tim Cook is retiring, but I think their succession plan is well taken care of. So anyway, let's put this on a daily chart. Take a look at our trades. All right, so we have 17 open trades right now, and we're looking at Costco. Okay. Costco, we have a bull call spread, 965 to 990. And of course, what does Costco do? Promptly pulls back. Okay. Still holding the 200-day so far. Unfortunately, we're down 33.4%. Now, here is a play. Here's a stock that you guys know that I have a lot of conviction in. I like this for the long term. I own shares in my long-term accounts. And we're down 33.4%. And I have a stop at half of the premium we paid. And although I have a lot of conviction, this is a short-term option trade. And, this premium could go to zero. And what I'm never going to subject you guys to is max loss on an option play. And so here we are at 5.25 is our stop. That's half of what we paid for, a little bit less than half. And so if Costco can't get its act together, and we lose half of our premium, then our timing is wrong and we need to move on. Doesn't mean I don't like Costco, but for my long-term positions, I prefer leaps or shares, and I prefer shares more. I can't own as many of them as doing options, but that's the way it is. And so far, we're down 34%. MACD is looking like it's flipping over. So, I mean, this was a terrific run. I'd like to see this go a little bit more sideways, but we do have about 3 weeks to go until expiration. So we'll see what happens with Costco if it ends up bouncing off this 200-day here. A new one from yesterday is FLR floor, and Nice recovery today. You can see this long tail just like the market. And so it's holding up. And we should have, let's see, when do they report earnings? February 17th. So we'll close this before earnings, most likely since it is short-term premium. But the nice thing about having something with an expiration date after earnings is that we don't have to worry too much about decay. Directional movement, yes, but not decay because as we get closer to earnings, then those options get pumped with more and more volatility, and therefore um, volatility or decay is not our problem. Our problem will be direction. So we put a 50% stop on these. Nice little uptrend up here, and hopefully we get some movement and we make some money on this one. The one that really is irritating the heck out of me, and did we hit 50%? We're almost there, so we could be stopped out on hog. Um, so aptly named, at least, because it's been a pig so far, and thought we had a nice bounce going here and then here again, and so made a lower low today, and so this one it has a stop at 85 cents. So let's see, where is this one? All right, so we may get stopped out tomorrow. So let's see here. This is the February 20th, February 20 calls. Okay. Um, Huh. So the low was 90 cents today. So we did not hit that. We didn't hit our stop. So, but we might tomorrow. So let's see if this can do anything. So far, it's been a boring trade, but unfortunately boring the wrong way for us. All right, Hood. Um, in a downtrend, long-term play here. Earnings are next week. So this shows that we're down 60%, but that's only because we sold a put spread with this, and that put spread is at the 85 level, so we're about 15% out of the money. And so this doesn't concern me at all. We've come back from a lot worse on these. So I like this play. We sold an 85-65 put spread. We bought a 110-130 call spread. This one goes out to April, so April is how many days away? 78 days. Now, earnings are on what day? The 10th. So it's not really next week. Um, so the 10th is the following week. So we have a little bit of time for recovery. So we will give this room. I put a stop at 95 and a half here. We'll see if we end up stopping out based on the 95 level. Hopefully not. But we have to go all the way back here or here. I think this is where support is right around, right under the 95 level. So we'll keep an eye on that. But so far, not off to a great start. And honestly, I hemmed and hawed about putting this out, given that earnings are this soon. But I liked the 200-day, at least thought it would get a better bounce. But the market so far hasn't been supportive, and neither has Bitcoin, because it is affected a little bit by Bitcoin prices. And I should say more than a little bit. We'll see. All right. HRL, Hormel, holding up pretty well. It's consolidating sideways. I like to see that. Here's another one where it's friends with Hood because we're down 60% on these as well. This is a long-term play into January. And so far, hasn't done anything wrong. It's a nice little boost and then sideways action. Do we have an earnings date? No, we don't have. That one is probably really late in the reporting season, so nothing to worry about with this one. Not that it will matter, given that it's a long-term trade for us. So hopefully this one can start moving up with the staples and what have you. Intel, Look at that, down 12 cents on a day like today. So we've taken a couple uh, profit targets on here, 355 and then 670, and it's still holding up at 660 $6.64 for our call, right? Yeah. 675, 750. So 710, give it, call it 710 for these calls. So nice start and caught a nice bounce on Intel. We need more like these, right? All right. IWM, as we saw on the RUT chart. So they're both at virtually 100% correlated because they are one and the same. The RUT is the much larger version of the IWM. All right, so we've got a little nice bottoming tail on the IWM, and what we have here is a $10 wide call spread. So we're down about 16%, and I checked on this intraday. We never got hit in terms of our stop. So we're still in the game, and usually I like to wait to the end of the day, but when we have a 50% stop, and it doesn't look like we're having any recovery, then we'll take the stop intraday on some of these pure premium plays that we have here with IWM. So let's hope that this one can recover. We have about 3 weeks until expiration. Yeah. JPM having a nice day on a really ugly day. It was up $5.65. So very nice for us in our long-term play. We're up about 17%, and I don't think it's too late to get into this one. So what did we do? We bought a 300, 350 call spread, and we sold a 230, 180 put spread. So this is a long-term play, and if you're not in it, you want to participate, you can. You don't have to sell the put spread if you don't want downside risk, but I like JPM. It's one of my other favorite names for the long term. And we've been buying that for clients as well on this little dip here. It's best of breed, in my opinion, of all the money center banks. Like them or not like him, Jamie Dimon is a very good banker and a very good operator. And they've really preserved an iconic name in the JP Morgan name, and done very well for themselves. Here's Morgan Stanley going sideways now ever since it gave back this big candle on earnings. Had a little bit of follow through the next day, but MACD is negative. We rolled this out this week to March, the 160, 180. And we are up a whopping 4.4%, but still down on the trade, no question about it. And so even though we collected $5 on this selling of this, and what I've been doing ever since I'm just can't trust the calculations on the system is when I roll something, I'll close out the old trade, show the loss there, and then start the new trade however we do it. And I think this is easier for members to look at and grasp, although you'll still see the whole text here telling you what we're doing. And that way, anyone who's new and wants to do this trade, they can. This one certainly can be put on if you want. Actually, no, I wouldn't put it on since it's so close to the money, but I like Morgan Stanley as a financial. Earnings are out of the way. So if you wanted to get into something like this, I would probably go to one standard deviation out. That's $15 in March. Why am I going out to March and not February? I want to give myself more room to be right and not have to be so close to the money. So $15 from 182, that's call it 165, maybe even 170. So this is definitely one standard deviation out. 165, 150, you could sell something for $1.28. If you want to be more aggressive, you do the 170, 155, collect $1.87, and you're giving yourself at least $12 out of the money to earn this. And as I've said many times, I'd rather have a lot more time to be right than try to jam myself into something like uh, a, a February, unless there's a compelling reason to do a short-term one. And sometimes there is when the volatility is there. But if you look at Morgan Stanley's IV percentile, 11% is not enough to get me excited. And therefore, taking a one standard deviation out, $10 out of 182, that puts us at 172. All right, I'm going to do a 172, call it 160. That's $12 widespread for $1.06. No thanks. And we were doing a very short-term one because we had elevated volatility in the January 30th expiration, but that didn't work out for us in any case. That's what I like, and I'm not worried about this one. I think we'll get our money back on this one for sure. NVIDIA. We closed out, by the way, the MSTR ones today. Now I'm kicking myself a little bit that yesterday I didn't just have everybody close out the whole entire, I said partial or full. And then today, MSTR gets hit. I don't want to gloss over it, but here we have a new 52-week low. I mean, this thing hit at $139 and, this is, everybody knew the risks, and I put it out there that, it's highly correlated to Bitcoin, and Bitcoin's having a hard time. So my personal opinion and is that Bitcoin, excuse me, Bitcoin is going to, excuse me, is going to struggle, I think, this year. And we probably won't see a better action until the fourth quarter from Bitcoin, maybe even later. And that's what usually happens after the Bitcoin halving event. We have a period of euphoria. We got up to 125,000. And so there'll be ups and downs and short covering rallies and what have you. But I just don't think we're going to see a big rally in Bitcoin before the fourth quarter of this year. Personal opinion, take it for what it's worth. But we took a shot with this one on a short-term option trade. We made money on, call it 3/4 of it, and then got stopped out on the rest. And hopefully nobody kept too many of these or got hurt with this drop today, because it was a significant one. And the reason I decided not to roll out the rest of these is because hindsight being 2020 and not really trusting Bitcoin to rally hard, and then earnings coming up, I just didn't want to continue with the risk in this name. So NVIDIA, we have a full put spread, right? February 170, 150, and we are up 52%. If you haven't harvested, yesterday we were up about 56%, so we harvested at least 1/2 to 1/3 to 1/2 of these. If you haven't taken any off, you should. Look at that, ended up 99 cents on the day. This thing, I think if it can get back up over 200, then it could run and take us to all-time highs. But it's stuck in congestion here. I mean, look at all that. We've been sideways for months and months. And, what better instrument to have than the put spreads selling on this? And we've been doing this for months. I'm just realizing, guys, that this is the resolution probably switched on me back to 4K. And if you're seeing this and it's too small, or you need me to adjust, put something in the question panel, ask me to change the resolution. I know I changed it beforehand, but I did close down a couple monitors, and that might have reset the resolution. But in any case, we're almost done with the trades. But I'm just realizing with the size of the typeface and how sharp things are, that this is probably still in 4K. So if it's something you prefer in just regular HD, just let me know. All right, so here's a disaster du jour. Palantir. We're down again 68% on these, and we have the uh, February 170, 161.35. So we are definitely at the below our stop. Where's the stop put? 155. What I'm going to say is that um, I will make a decision tomorrow or Monday before earnings whether we roll this or keep it where it's at, to give ourselves more room in case something weird happens. But I want to give this time. Earnings are on the second. So is that Monday? Um, I don't know. Usually have, yeah, I guess that is Monday after the close. So we will roll this, or I will put something in the forum and on Telegram that what to do with this. We may roll this out to March or April, just to give ourselves more room, and we'll roll it for a credit of some sort. So I would not follow this stop, but if you want to, you can. This is again my conviction in here, and you don't have to follow what I'm doing or saying. Now, Rocket Lab is I was probably too early to get back into this after we harvested some nice profits, but we're only down 14% on this particular play. So it's holding up very well. It was down $2.89 today. And we made some nice profits with our prior 30 70 spread it was. In any case, this is a long-term play. I'm not worried about it. I think these space companies are going to do very well in 2026. And so far, Rocket Lab has proven that. I think they have earnings coming up. I mean, as if earnings mattered for these guys. We know that the earnings are negative or what have you. All right, SLV. What a wild ride today. This thing end up green? No. Down 9 cents. So uh, hit 109.83 and it was down at $96. So we're up 60% on this. And you know, what we did here is something we taught a while back ago is the back ratio. And we sold the 100 put and we bought two of the 90 puts. And sure, we could have taken some profits off at 60%. But you know, what's the fun in that? We basically sold it for a quarter. We're gonna sell them what for 40 cents. So what are they going for? What am I guessing here? No bid? Really? How can that be? So let's go to the option chain here. Take a closer look at that. All right. Little zoom indicator. Yes, I know you disappeared the controls. So we have the February 20th. We'll make this bigger. So this was the 190. All right. So look here. We sold the 100 puts. We sold one of those, and those are currently at 112. I think at the time we did these, um, they were closer to 114, 115%. And before I go any further, guys, just take in the fact that silver SLV is trading with 111% volatility. Okay. What that means is that silver at 105, okay, look it up here. The composite implied volatility is 116%. What this says is potentially silver can be up 116% within 22 days, or it could be down 116%. Now, zero is the floor, but this is how crazy it is in silver. And if you look at the IV percentile, 100%, it's never been higher in its life. And not the sidetrack thing. So uh, this is the AGQ. This is the ProShares Ultra Silver ETF. I'll tell you what I did. I came out here earlier in the week and I picked a 2 delta put. I think it was like here we are at 399. And I went not one, not two, not three, but four standard deviations out of the money, which means that I had a 99% chance, 99% chance. And this is what I tell you guys not to do. And I sold one put on it. So let me show you the chart. Okay. Don't sell puts on leveraged products because A, they're illiquid, and B, you don't always get your money out of it. So this thing hit a high of 431 this morning and was down at 334 at one point, and it recovered quite honestly. So I found a put with a 2 delta a couple of days ago, and I sold it for $2 for the heck of it. And it's like this thing would have to be cut in half before my puts would get hit. Well, wouldn't you know, um, today the volatility even went higher. This is 290% volatility. I mean, it's unbelievable. And um, so the $2 put that I sold was still way out of the money. But the way the thing was coming down, I said, you know what? I don't need this aggravation in my life. I closed it. I think I made like $50 out of the $2 out of it, and I just closed them out. And then it looks like I probably would have kept most of the premium. But the way this stock was coming down, if I put it on a 5-minute chart, I mean, look at that, 435 pre-market and just coming down. It looked like it was going to zero. And if you're not affected seeing something like that persistently down, then you must have uh, AI for a brain. So anyway, that was my little bit of fun. And I've been doing this a long time, and like I said, I just did it for kicks, and it basically was not worth the risk. I can tell you that. So do as I say, don't do as I do. All right, back to SLV, and not the 17th February. We sold the 100s. That's 112% volatility. And we bought two of the 95s. Now, this is at 111%, but we had like a 3 or 4 percentage difference between the two. So this is where we say the skew is in our favor. We sold high volatility and we bought lower volatility. And at the moment, I think we had like 2 or 3 percentage points difference. And that puts the wind at your back, as we talked about. So right now, if you want to put this out, $4 debit. Am I reading this right? So we sold one, bought two. Okay. So is this worth $4 now? Maybe we should have taken profits. That's interesting. We put this on for 40 cents. So sell one, buy two. Okay. Sell two, buy one. Yeah, it's $4. And this is telling us Okay, $4.15. Why is it only a 60% credit? So I'll have to look into this, why this is insane. I mean, that's a nice profit. So maybe some of you guys harvested this. So some of these, we did this for 25 cents. Some of you couldn't get in for like 30, 40, 50 cents, but still, that's 8 times our money. We should have harvested some profits on these. And I think what we're looking at is the implied volatility getting pumped in here. And I don't know why this is saying 60%, but I'll look into it. Sorry about that, guys. All right. I digress. Charts. Back to daily. Yeah, I mean, that's more than 10 times our money on that. All right, SPY. Nice little bottoming tail. And we have two plays, and one of them is our 660, 600 put spread. We are down about 60% on these. And obviously, with today's actions, we weren't able to. This is the March one. I'm getting ready to roll these or change this up a little bit to get it closer to the money. I still want to have a long-term hedge. I might move these out to April since we're coming into less than 9 weeks to expiration. And if this is a long-term hedge, I want a little bit more time on it. But in any case, as we'll talk about in the lesson, we want to have a hedge for a lot of our trades here, although it has not really done what we needed to because the SPY has been so resilient. But we did harvest some profits on this inflection point spread, $2.55 we took today on this. We bought them for 40 cents. And so this was about, at the time, a 245% gain on these inflection point spreads. And the other ones in March are not doing so well, but I'm not worried about them. This is our hedge for so many different put spreads that we've sold. Okay. TLT. This one still going sideways, up and back down and up. TLT opened down and closed up a penny. And we still have about 43 cents, about half the value left in this put. And it's been up and it's been down. And when it got down to 24 cents, I should have rolled it out to March. But we have plenty of time. And we are at the 86 level. We're above the short strike, so we're okay with this. Last one, XLP. Giving back a little the last couple of days, not pretty action. And one of the things that told me that today was not going to be terrible on the market side, this was a little bit of a clue, the fact that XLP was not taking off on a bad day. So usually they go to defensives to make this basically that's where they hide out when the market is selling off. But today, they didn't do that. We're still up 36%. I don't know if any of you have taken some profits. We got to about, I think we got close to 50, maybe over 50% at one point, but this is a long-term play. These are still buyable. The 80 calls in January, if you're not in them, you can buy some. And we'll just give this more time for a long-term play. I still like it, although I'm not crazy about this MACD, but this is a daily chart, and we should be looking at least at a weekly chart. That looks much better. MACD is looking good. And if we look at a monthly chart, looks like it's just getting started. So those are all our trades. Let's count them up. We've got 1, 2, 3, 4, come in, 5, 6, 7, 8. So 8 out of our 17 are underwater and the rest are profitable. So better than 50%, but you know, this comes back to the lesson we're going to talk about and continue from last week. But let me check to see if we have any questions. No questions. Nobody cares about the 4K font. Okay. All right. Good to know. I know when you're on an iPad or something like that, a smaller iPad, it's hard to see some of the numbers, but all right. If we don't have any questions, we will flip over to continue last week's lesson and option inventory building and management. So let me find my notes here. And we left off at slide number 6. Okay. Come on. Okay. Apple still holding up at the 260 level. Reminding me of the FOMC meeting and the press conference. It was like a sleeper. So we talked about last week, what are you trying to do? Yeah, we're all trying to make money, duh. But we got to figure out what are we doing in terms of premium selling, and how do we do that by keeping risk in check? All right. So talked about the market being derivatives driven, mainly that option markets are driving more of the action in the stock market than ever. And so at one point, tech was the only thing holding the market together, but we got a lot of rotation going on under the surface here. So some people say the VIX is elevated, some say not, but in any case, we are in a weird environment where the markets keep going up, and I realize it too, that our hedges aren't working as well as they should when the market is down. But when the hedges aren't working, it tells me that this market isn't serious. And when you see a lot of 50-50 breadth, 50% up, 50% down, whether it's in volume or in a number of issues that are advancing versus declining, until you get full-blown correlation, 90% of the S&P 100 or 90% of the NASDAQ 100, you just have a garden variety pullback or choppiness. Is this where we left off last time? Is this number 5? Okay. So the basic idea when we're selling premium is different than the strategy of trading. And it's basically closing profitable trades and managing your losing ones. Okay. When we get through this portion of the lesson, we're going to spend more time on really getting into depth on deltas and managing deltas. And we have had a session on that in the past, but that one dovetails again. So it wouldn't hurt to do a review and a deeper dive into deltas, because if you are going to be a premium seller and you want to make money and you want to generate regular income, then delta is your friend in terms of knowing it inside out. And in fact, knowing more about the Greeks is going to basically save your bacon, because understanding a little bit more about the Greeks, and we will have a session on those, the more you're going to be successful in managing your premium plays. Okay. So we say, don't hold on for the perfect trade. And I'm going to do something here because I want to fire up. Give me a second here. I want to fire up Tasty Trade for a little demonstration. And I haven't used Tasty Trade in a while, and I want to make sure it's updated. Okay. And I'm getting it ready. I guess it has been a while since I opened it. Let's see here. Okay. Okay. Come back here. All right. So when we're selling premium, and here we go, let's back up here. Um, we're always looking for the probability of profit and not worrying so much about whether we can harvest 80 or 90 or 100% of the premium collected. And as you guys know, in our trades, I aim for 50 to 55% as an initial profit target when we're selling bull put spreads or puts or what have you. And we haven't really done that much in terms of iron condors and selling bear call spreads. Um, and we'll get to that as well. But the whole idea is that we want to harvest the premium when we have at least 50% profit and hold out for more on, say, 1/3 to 1/2. Okay. So there was a trader who I didn't know personally, but he tells a story that he was starting out new in the business, and he went to another trader's office, and he agreed with that he could come kind of observe and look at what he was doing and see him trade. And he looked at his trade and says, "Holy smokes, you've got all these trades that are down 4, 5, 600%." And this guy was a seasoned premium seller, making seven-figure portfolio, and he was making about $6,000-7,000 a week selling premium. And so, but when he looked at what the guy had in his option inventory, he saw a whole ton of things that were down multiple hundreds of percents, and he says, "Why do you have so many losing trades?" And the guy's answer was, "Because I already harvested the profits from the winning ones, and that leaves a lot of the losing ones." And you know, to him, it didn't make sense that he was holding on to these. But when we get to the part of discussing, what is your delta tolerance, you'll see that if you keep your risk and your deltas in check, then you can hold on to premium sales for a lot longer than you might think, because you're managing the winners and you're letting the losers kind of work themselves out. Because if you believe that the market is a cyclical being, and I do believe it is, sooner or later, you will get your chance to close a lot of these trades that are far out of the money. Palantir as an example, that will come back into your favor. And as long as you manage your risk and keep the position size small, then you won't have to worry about bailing out on trades that generate premium for you but are out of favor right now. So what we say is manage your delta comfort, not necessarily closing every position. All right. So inventory allocation, using the military analogy. All right. Naturally, when you have an army, and they're positioned in a certain location, they're not going to put all their ammunition and all their soldiers in one set of barracks. They spread them around in different locations and in different barracks, and so that if one gets hit, not all of them get hit. And so I'm not a military guy, never been in the military, and I appreciate everyone that has served, but hopefully that analogy serves as a good example of when you become a premium seller, The one thing you don't want to do is concentrate all your premium in one underlying in one expiration, and certainly not in the same strike. So you want to spray or spread your capital around multiple expirations, multiple underlyings, and multiple um, uh, strikes, so that if things go badly for a certain underlying, or in they go in one direction or another, you're not going to get hit all at once. And so if we take a look at, and I'm going to put up the chart of um, the SPX again. Okay. All right. Let me get rid of these alerts. Yes. A damn too many alerts. All right. So here is the monthly chart. I'm going to go to the daily chart. And in fact, maybe I go to an hourly chart. Do I have enough? Let me go 30 days. 90 days? 30 days. Okay. When you look at the SPX, all right, this is an hourly chart. Okay. We can go back to December. We can even go back further. I'm pretty sure that let's see if I can. Next time frame is 90 days. Okay, that's still December. Okay. Zoom out. Okay. Take it for its silliness, but what do you know? What do you notice? We have been stuck between, call it 6,800, and really we just traversed out of 6,900 these last few days. So 6,800 to 6,900. So we've been sort of in a box for so long. And if I knew how to draw a box, I'd draw it for you. But 6,800 to 6,900 has been the range that we've been in. And so what's happening all this time is we're building a lot of risk between 6,800 and 6,900. And if you want to call it 6,800 to 7,000, have at it. But there's not a lot of activity. But here's the top end, 6,900. Here's the bottom end, 6,800. So when you consider that people are putting on positions and putting on positions every day, going all the way back here into this is October. Okay. What do you think is going to happen when the market breaks out either to the downside or the upside? Okay. There's just so much accumulation of open interest in these strikes that typically what you know from technical analysis is if you've been in a box that's 100 points wide and you break out of that box, you have a measured move, probably 100 points down or 100 points up at least, maybe even more. But so what we're having here is so much open interest here that we're going to get an explosion one way or another sooner or later if we can traverse 7,000 and keep going up. I mean, technically you could say we already approached the 7,000, so we already exhausted that. I don't think that's the case, and I'm no expert on measured moves or technical analysis, but what I'm trying to say here is if you're that guy laying risk upon risk upon risk in this area, and whether it's a short premium or long premium, okay, when we leave this box and we leave it hard and we go into one direction, if you've sold premium all in the same range, in the same expiration, in the same strike area, this is going to hurt you quite badly. And so if we go back to the presentation, what you want to do if you want to generate income in your portfolio by selling premium, then you have to learn to spread your risk around multiple expirations, multiple strikes, and multiple underlyings. Okay. If one position gets hit, the rest of them won't. Okay. And it gives you more flexibility. So if you do one lot here, two lots here, three lots there, you're going to be okay if the market goes against you and it's butting up against your particular short strike that you're doing. So, and we're going to talk about and do some examples there, uh, and actually have you do one next week. Obviously, we can't do it live here, but give you an idea one. So, when we look at Thinkorswim, come back here and we'll use the SPY. And I might have touched on this last week. All right. So we have 22 February, and I'm going to change this column to something what we've looked at, probability out of the money. Okay. So you're looking to sell an option. No, I don't want to do February. I want to go out and say, I want, this market's been going up to the upside. Let's assume we're up $10 on the day in the SPY, having a great day. I want to sell some premium. And what I'm going to do is usually I'm not going to go out to February, not going to go out to March. I'm going to look for something that's either 78 to say 120 days. So I can give myself lots of room and lots of time to be right. Let's say I go out to May 15th and it's 106 days. I get it. All right. And so this column here, and let me make these columns a little bit, is probability out of the money. Okay. This is basically the odds of you of this option closing 1 penny in the money. Okay. So we'll go down here and we're currently at, call it 694 is where it closed. And I want to have, let's say, a 90% chance of this closing out of the money. Okay. And as you know from prior sessions, this is an 11 delta. Okay. 11 delta is equivalent to 90% chance out of the money. This tells you, yeah, it's 90% chance of being out of the money. So you could sell this $2 call and you know that you have a 90% chance of keeping this premium. All right. And that's great odds. But you also have a 10% chance that this will be in the money. SPX, SPY 760. All right. So what do? We essentially try to close this when we've gotten at least a 50% profit or 55% profit is what Tasty Trade Research calls the sweet spot for closing premium trades. And I didn't just invent it. They did all the research and they did the studies and found 50 to 55% being the sweet spot for closing. And they usually advocate closing the whole position. And I'm not wedded to closing the whole position. Obviously, if you have a small position, a couple of them, you take one off, you keep one on. And so you want to keep this. And at some point, when it gets down to $1, you close it. All right. But if you want to even know what your probability of profit is, that's something that's not available on Thinkorswim and not available on most platforms. But for those of you who don't know, that a lot of the same people who designed Thinkorswim, worked on Thinkorswim, moved to Tasty Trade, and they designed Tasty Trade. So if I go, I'm going to bring up Tasty Trade here. Something they never built into Thinkorswim was the probability of profit at 50% profit. So we're looking at the May 760 call. So I'm going to bring up Tasty Trade. And I probably should bring this up more often with you guys. All right, here's the SPY. Okay. And you can see here the May 15th, 760 profit, 760 call. And if I click on selling these, okay, obviously you have to have the margin to be able to sell a call naked. Otherwise, it's going to be a call spread. But I'm going to show you a little bit of a trick to making this happen if you're approved for futures. All right. What Tasty Trade has that Thinkorswim doesn't have is the calculation, the probability of a 50% profit on this. And this is 99%. Okay. So the odds of you making 50% of the premium on here are 99%. Okay. So if I want to go back and say, well, what if I do the April ones and I go out here and I want to sell a $2 option in April? All right. Here I'd have to go to the 743s. Okay. And this is probability of touching. What about the where is okay, out of the money percentage. There we go. All right. So if I want to collect $2, I got to go to the 744s. All right. So this one only has an 88% being out of the money. What if I sell the 744s? Well, still a pretty good percentage. All right. Only 95% probability of keeping 50% of the, well, hang on, let me clear that because it took both of them. Sell the 744s. Probability, it is 99%. Very good. All right. So what if I went up the chain, said the 740s, which are 85% out of the money, chance of being out of the money, and these still have a 98%. So what you're seeing here is I'm going out and allowing a lot of time and far out of the money. And when I get to a 50% profit, I don't care, or a 55% profit, even 60% profit. I take 1/3 to half of them off because, you know, at some point the market could go crazy, just like the gold and silver market, and run you over. And so if you're harvesting profits regularly on these, and then the next time you come and you want to do another sale, the market keeps moving up and you want to do another sale. Maybe you come out to June. How long is June? 140? It's probably too far out in time. May 29th. Yeah, 120 days is about as far as I like to go. Then I could come out here and scatter one here, collect $2.31. Oops, I don't want to clear that. Come on, clear. $2.31. Okay. And this one has a 99% probability of 50%. Okay. And it has an 89% of expiring worthless. So yeah, the odds are in your favor. And when you do this and you scatter your inventory, and maybe you do Apple or maybe you do Tesla, whatever, you get a higher bang for your buck. And we're going to talk about this more next week. When you're scattering around different expirations, and forget about your focus on short-term duration. Remember what I said last week is that when you focus on shorter time frames, basically gamma makes you its bitch. Forget my French, but that's what happens, especially with short term. And as experienced as I was and am with this, I got caught up in some gamma risk, even with 3 days to expiration, 7 days to expiration. So it doesn't mean you can't trade them, but you just have to be aware of them. If you are trading for income and premium selling, then going out in time gives you so much more flexibility than trying to do short term. All right, I'm going to stop there, run over quite a bit. And I know there's a few questions here, so let me answer those and then let you guys go. So there's a lots more to come guys. So harvest profits on the 320, 660, 600s. No, Michael, I don't think we did. We don't have profits on those. So not sure. So Michael's saying SPY hedge 60, 660, bought for 860, close credit 525. We did not make money. We lost on max. Am I confused? So no, Michael, we were talking, we have two trades on the SPY. We have not made money on the June or the March SPY trade. Let me maximize that. Where did it go? Oh no. Maximize. Thank you. Okay, so this SPY trade is we're down 60% on it. This is not the one we sold today. The one we chipped off is the one we put on a couple of weeks ago, this inflection point spread where we bought the 690, 670 put spreads, and then we sold the 600 put in April. So we did close this one for a profit of 245. This one we have not closed yet, and it is underwater. So hopefully that clarifies that. So that's the SPY hedge. Yeah, closed today at credit. So we did not close this. We did not put this one out. So if you closed it, I'm sorry, but we're definitely going to put something different on to reposition this. Screen resolution. Yes, we closed one of the inflection point spreads, Michael. We didn't close the 600, 660. So go back and look at that. You can see here, we have not in this active option trade list, we have not closed any of these today. We closed some of these, the inflection point spread. This one is just a plain bear put spread that we had. We didn't close any of these. Come back at me if you think you saw something different. Okay. Screen resolution is not critical. My screen is 32-inch and I can easily see the complex charge. All right. Thank you for that. We did. Okay. Yeah, we're all tired now, Michael. No problem. So again, if you close that in error, you want to be back in it, you can just buy it back tomorrow. But I think we're going to do a different one to reposition that. So thanks for hanging in there, guys, with me. And we ran long, and we'll continue with this. And there's a lot more good stuff to come with this presentation. And we probably spent more time on some certain stuff than we should have. But I appreciate you guys being here. And I will be back in the room with you tomorrow. And if you're taking Friday off, good for you. I will see you in the Sunday video. Take care. And yes, dinner time on the East Coast. That's right. And for those of you in the snow and the cold, I won't say haha. I'm in California and it's 76 degrees and sunny. So anyway, I just did, I guess. So take care, guys. Thanks for being here, and I will see you tomorrow. Bye-bye.